the money that you were expecting for life isn't going to be there. And this is not just true of annuities, but it's equally true of pension funds and Social Security. This is a crisis.
Ric Edelman is a guy who Barron's recognized for several years as the #1 financial advisor in the country. He also had a nationally syndicated radio show, The Ric Edelman Show. We're going to talk to him about a potpourri of topics. I want to talk to Ric about everything. I want to talk about the problems with longevity, about annuities, about where he stands on crypto. We pick Ric's brain, and as always, I'm sure Ric may have something to say. And I'm super happy he's here with us in Mom's basement again. Ric Edelman's here. How are you?
Joe, it's good to be with you as always.
It is fabulous to see you again, my friend, and congratulations on, man, all the stuff going on. But what I'd like to do, Ric, is there's so much going on right now in personal financial planning. You obviously, between the Barron's accolades, and heck, I've told everybody, I told you this when we met in Boston at an annuity conference, that your initial book, The Truth About Money, is my favorite book about financial planning. So I just want to pick your brain on some of these hot topics now, if you don't mind. Is that all right?
Yeah, sounds great.
Let's start here. Interest rates raised again as we record this a couple of weeks ago. We always see that the economy follows a little bit behind that. There were some people that thought that the Fed might be overstepping, right? We've seen them go up more quickly, I think, than they have in any time in the last 30 years. What is this going to do to the economy? Do you think that the people, our stacker community, needs to watch out that maybe the economy might have some drag coming that we're not seeing yet?
I'm not sure if we're not seeing it or we just don't want to acknowledge it. Everything is incredibly obvious, I think, what's going on right now, and yet the markets are shrugging it off. My biggest concern is real estate. The high interest rates are, I think, setting the stage for a real problem, and it's all a result of COVID. We all know painfully well what has happened over the past 5 years, from pre-COVID through COVID, now post-COVID. And what it all means is that we took interest rates down to near zero levels. Huge numbers of real estate developers obtained loans to develop property, to refinance their existing properties at these very low interest rates. Well, now many of those loans are coming due, and they have to be refinanced at today's interest rates. So that 1% loan, 2% loan you got is now a 5 or a 6% loan, and that means the monthly payment is skyrocketed. And at the same time, because of the aftermath of COVID, with everybody working from home, a third of U.S. workers are now working remotely. Office buildings are empty. Companies are realizing they don't need that space. And that means two things. One, companies that have leases are letting them go, and new companies are not interested in replacing those rents. So the landlords are discovering that the rental income has dried up. At the very moment that they have to refinance their loans, and they don't have the loan income, they don't have the rental income to pay off that payment, so the landlords are in trouble. And this means we're going to see a massive number of defaults. They're going to hand the keys to those buildings back to the banks that provided the loans. The banks are going to discover that the properties aren't worth what they were worth before. They're only worth 60% of what they were worth before, maybe even less. And this is going to force the banks to mark to market. And this has not yet happened, but it's going to. All of the owners of that real estate, pension funds, endowments, institutional investors, private equity, venture capital, they haven't marked to market in their portfolios yet either. Non-traded REITs, they haven't marked to market yet either.
Yeah.
And so all of this is coming in the next few months. And it's going to be terrible news for those who are the current owners of those properties, the investors in the funds of those properties, the banks that have lent to those properties. This is bad news for all of them. It'll be eventually good news for new investors who will be able to buy these properties as a vulture fund at pennies on the dollar. We saw this in 2008. It was really, really ugly. Eventually, it all worked out. Look how great the economy and the markets were through the 2010s, but it was really ugly from 2007 through 2009. And that's kind of the storm we're entering right now. How much of that is already priced into the market? I'm not sure. So far, the markets will tell you they've priced it all in, which is why the stock market has not dropped. It's why the market dropped last year 30%. That's when they priced it in. So the fact that we may be headed to a deep recession, markets tend to anticipate recessions. And so the markets fell last year before the recession. As the recession hits this year, the markets will emerge quicker. So it's hard to say exactly what's going to happen over the next few months. There's so much uncertainty in the markets right now, and yet I find many people are simply not paying a whole lot of attention to any of this, or they're discounting the negative results that all of this could occur.
I also feel like, Rick, that's the reason why every time we meet, I feel like our hairlines look more and more similar because we worry about this stuff.
Sorry about that.
It's all right. No, we're the cool guys, right? I want to flip over to another area in financial planning, the place where you and I, the one time we met face to face, of course, was at this. I thought it was a great attempt at MIT for these all the people that are interested in the problems of financial planning around longevity to get together and work through them. And boy, some of the fights we saw between people on the media side, people like you and Michelle Singletary, and the annuity companies were much needed. Like these back and forth battles. Have annuities gotten better since that time that we met? I think it was back in 2017.
No, they haven't, sadly. And I don't know if it's because they don't think there's a problem that needs solving, or that they haven't figured out how to solve it, or that the market isn't pressuring them to come up with a solution. I think, frankly, it's a little bit of all three. So I think it's worthwhile, Joe, if we remind everybody of what we're talking about here. Yeah. MIT's Age Lab put together an event and invited me to speak, and you were there, and there were CEOs of some of the biggest annuity companies and insurance companies in the country who were there, several members of the media, such as our friend Michelle Singletary from the Washington Post.
Gene Chatsky was there.
And the reason I was invited and the reason I agreed to go, I mean, I know Joe really well, who's the head of MIT's Age Lab. I'm pretty deep, as you know, in the longevity space, recognizing at MIT and Stanford's Center on Longevity and the Milken Institute's Center for the Study of Aging, everyone studying this stuff is pretty much in agreement that if you're alive in 2030, you're likely going to be living to age 100. This is shocking. This has never happened in human history. And so we have to evaluate, if we're going to live to our 90s and hundreds, is today's financial, economic, and social structure designed for that? And the answer, of course, is no. Social Security, when it was built in 1935, you were supposed to be dead by 65. Annuity products today generally assume actuarially that you'll be dead in your 80s. What happens to pension funds and annuity contracts and Social Security when people start routinely living into their 90s and hundreds? These systems were never designed to pay so much money to so many people for so many years. And that is why, a big reason why I've been a big critic of annuity products, because they're setting up a lot of people for failure with a, I think, misleading sales pitch. That sales pitch is, put your money into this annuity contract, we will give you income for life.
Yeah.
Well, if your life is to age 85, they will honor that contract. But what if your life is to 95 or 105? I don't think the annuity companies are going to be able to make those payments because they aren't getting the rates of return. They aren't recognizing how many annuitants are going to be living that long and continuing to receive those payments. And what happens when those actuarial assumptions blow up? I think we're going to discover that the money that you were expecting for life isn't going to be there. And this is not just true of annuities, but it's equally true of pension funds and Social Security. This is a crisis. And my argument at that event, as you well know, to the insurance CEOs was build a product that works for today's longevity. And instead of effectively delving into ways we can solve this coming crisis, there was instead a big argument. Number one, they refused to even talk about it. It was 2:00 in the afternoon. We began at 8 that morning. It was 2:00 in the afternoon before I finally got so fed up that I demanded they start talking about it. And all they did was justify and rationalize why their current products are sufficient.
Yeah, literally everything, the whole thing came to a stop. You stopped the whole thing and said, nope, we're done. And then we had the runaround for the next hour and a half.
Yeah. It was unfortunate. There was a circle wagons mentality among the annuity companies, and I get their point. They've sold a lot of product to a lot of people, raising a lot of money, and they don't, I think, want to be in the position of having to admit that their products are going to fail 20 and 30 and 40 years from now.
Well, the other thing, Rick, that frustrated me was they also didn't, and this is another complaint people address, the way that annuities are sold fundamentally. People don't buy annuities, and they should be. If the product can last, people should be asking for them. But instead, we have to thrust them upon people, and they have this whole structure of sales that needs to be dismantled as well. And I think that was Michelle Singletary's whole MO, was to try to get that through their heads, and they don't want to hear any of that either.
Yeah, the big issue, I think you're exactly right, and so is Michelle, that the product themselves aren't necessarily bad. It's the way they're sold.
Yeah.
A lot of annuity sales reps are overly aggressive in touting the benefits and the promises of these products in a way that manipulates the buyers. I mean, let's face it, the person who buys an annuity is by definition a risk-averse person, because these products come with words like guaranteed and lifetime, no loss from stock market risk. I mean, these are the kinds of words that you use to placate someone who doesn't like investment risk. But what they're not doing is talking about the risks that do exist: the mortality risk, the longevity risk, the expenses, the tax risk, and so on. And so a lot of the concern that Michelle was raising, and which you and I echoed, was that the sales tactics are often abusive. And this is why the state regulators will tell you that annuity fraud is among their perennial top 10 list of investment frauds in America. And so they didn't want to hear that either at that event.
Continues to put a pit in my stomach. You are here with the Digital Assets Council of Financial Professionals, and your podcast, The Truth About Your Future. I've been fascinated by your podcast. By the way, any podcast that can make Tupperware interesting, but not for the right reasons. I'll let people listen to that episode. But I want to talk about some of the things, some of the modern money stuff that you talk about on The Truth About Your Future. Let's start off with this. What's your take on the future of central bank digital currency? Where do you think we're headed?
We're headed toward it. And I talk about it a lot on my podcast, The Truth About Your Future, which is the successor to my radio show. I've been hosting radio for 32 years. And this year I converted my radio show, which was once a week, into now a daily podcast, The Truth About Your Future. And it's in the top 1% of podcasts already. I'm very excited. It's doing so well. Great
More
production
than that,
team.
Rick, you look like you're having fun. It just seems like you're having a good time.
It is. It is fun to talk about these topics. They're intellectually interesting, and they are of a huge impact to a great many people, and it is fun to do. And I'm at the stage of life, if it ain't fun, I ain't doing it. I mean, that's kind of my metric now of whether I'm going to accept an invitation or do anything, and that's why I said yes to you, Joe, because this is fun.
Yeah, thanks, man.
But if it ain't fun, I ain't doing it. And CBDCs are something I talk about a lot on the show, because this is one of the big innovations that's coming in this decade. A CBDC, it's in short, I'll refer to it as a digital dollar. Right now, our dollars are paper. There aren't very many businesses today or industries that operate on pen and paper, and yet dollars are one of them. We have the government printing dollars and then distributing them by armored vehicle to banks around the country who stuff them into ATMs where you have to go to physically get the cash. This is nuts. In a digital world, why are we playing with paper money? We're using credit cards and debit cards and PayPal and Venmo and Zelle. Why are we still printing money? And so there's a movement to move toward digital dollars. They're called CBDCs, central bank digital currency. issued by our central bank, the Federal Reserve, and they will simply have a digital version of dollars. And they will be the same as the paper dollars, except instead of having the dollar bills in your pocket, they'll be in your digital wallet in your smartphone. This makes a total amount of sense. It's a lot cheaper. It's a lot safer. It is available 24/7. The government loves this because it not only saves them money, it's a wonderful way to thwart terrorist financing and drug cartel financing. It's a way to beat tax evaders. The IRS loves this. The Department of Justice, the FBI, even the Defense Department love digital money, and so do governments around the world. Every government around the world is exploring the development of digital money. 7 have already launched their digital currencies, including, most ominously, China. And this is why we've got to get in a big hurry. The Fed is working hard about this. A good friend of mine, Sunena Tuteja, is the Fed's chief innovation officer, and she is heading this effort to figure out how to do this. By the end of the decade, our Fed, every central bank, will be launching digital dollars, digital money, digital currencies in their home nation.
And by the same token, I've seen you recently on a couple other shows. You also, I believe, and tell me if I'm wrong here, that there still is room for crypto and crypto growth and use of crypto. Tell me, because it seems like digital currency, central bank digital currency, one thing. How is there still room for crypto and digital to live in harmony?
Well, you have paper dollars today and you have stocks. So why would a digital dollar interfere with stocks? It won't. Currency is one thing, assets are another. You buy currency because you need a store of value, you need liquidity, you need to be able to transfer money to another individual or company through payments. And then you have the stock market, the bond market, the real estate market, the gold market, the crypto market. These are assets that people buy because they believe they will generate income or they will grow in value. Usually a combination of the two. Like think of real estate. You get rental income and the property rises. Stock market. Stocks grow. They also pay dividends. So the fact that the Fed will create a digital dollar is confirmation of the legitimacy of this technology. That will increase, I believe, interest level and engagement in Bitcoin and other digital assets like NFTs and more. So it's not a question of either or. One doesn't eliminate the other. One supports and justifies the use of the other.
Do we have to see, though, the government get more involved with the oversight of NFTs? Because the problem that we saw in the last couple of years, Rick, as you know better than most, is not that NFTs are bad or that the technology doesn't help. Certainly, there's so many use cases for the technology, but it looks like some of these bros that created the technology have been cheating on us and are just making it their own little personal cash register.
Well, I don't know if they've been cheating. I think they've been exploiting the get-rich-quick mentality.
Okay,
I think they've been taking advantage of the stupidity of a lot of people. And that's true in any asset class. I mean, you've got penny stocks in the stock market. You've got pink sheet stocks. You wouldn't compare them to the S&P 500. And right. The same is true in digital. So you've got the underlying technology, which is doing really cool, amazing things. And then you've got some aggressive marketers and promoters who are exploiting that tech to make a quick buck for themselves. Well, you know, if you're going to fall victim to that get-rich-quick mentality, you know, you can't fix stupid. So there's not a lot I can do to protect you if you're going to fall for that.
I have a friend who's also my primary care doctor who has that on his desk. Literally, it says, "I can't cure stupid." right on the front of his desk. When do we get to the point, Rick, that grandma can think about buying crypto?
Oh, we're already there. I mean, if grandma already has a diversified portfolio, crypto is just another asset class. If you believe in diversification, if you believe in modern portfolio theory, if you believe in the efficient frontier, then you acknowledge that you need to have as many asset classes as you possibly can because different asset classes perform differently at different times. That allows for portfolio rebalancing, and it allows for tax loss harvesting and dollar cost averaging. So if you believe in that and you're already doing that with your portfolio, then you want to be as diversified as possible. Crypto is the first new asset class in 170 years. Why would you not want to add it to your portfolio?
Based on the screen behind you, for people not watching on video, Ric has a screen about the Digital Assets Council of Financial Professionals. I want to ask you this last question, Ric, which is, it must bother you, certainly bothers me, that so few financial advisors are still talking about modern money, or their client brings to them the issue of modern money and tell me where you're going with that, because clearly you have an agenda to hopefully make us smarter as a group of advisors.
Yeah, I created DACFP, the Digital Assets Council of Financial Professionals, at dacfp.com, as a crypto education company. That's all we do. We don't manage money. We're not running funds or whatever. We simply teach financial advisors and investors about digital assets, because since it is a new asset class, nobody has any experience with it. And that's a big missed opportunity as a result. Today, it's a really tale of two cities. Half of the nation's financial advisors personally own Bitcoin. And yet, only about 10% are recommending it to clients. That's a huge disconnect. The reason that advisors are not recommending this to clients, most commonly, their firms won't let them, because their firms aren't sure what the regulations are. They don't know what they're allowed to do or how to go about it. And so we teach compliance offices, and we teach risk management teams, the investment committees, the sales and marketing teams at firms, how you can engage in crypto in a compliant, safe way that is consistent with your firm's culture. And people are often shocked at how easy it is to do this, that it doesn't raise the ire of the SEC or FINRA, that there are ways you can go about this that are completely in sync with how you manage the rest of a client's assets. So the first thing we do is help advisors realize this is something you can talk about with clients. And second, this is something you should be talking about. Why? Because 22% of US adults own Bitcoin, which means a lot of your clients own it. And they did it without you because they didn't think you would help them. And you need to help them, because if they are left to their own devices, they will get themselves in trouble. They'll get caught up in those get-rich-quick schemes. They'll use the faulty platforms. They'll get involved in fraud and abuse. You can protect them as an advisor. But if you're silent about it, you're not doing them any good. You're also not doing yourself any good. So our mission is not really to champion Bitcoin. It's to champion education. Because once you understand how this works, you can figure out what you ought to be saying to your clients and how you can best help and protect them.
For our stackers who are advisors, we'll link to DACFP on our show notes page at stackingbenjamins.com. For everybody else, go listen to The Truth About Your Future. I've been binging it. And again, Tupperware, very interesting story about long-term care, by the way. The way you do this magic of weaving in these stories into our own personal financial planning it's amazing, Ric, watching the way you work.
I appreciate that a lot, Joe. And the podcast, it's every day, but it's only 3 or 5 minutes. It's a real quick, easy listen. We got great interviews every Friday in long form. And so I really encourage you to go to The Truth About Your Future. Get it wherever you get your podcasts.
Yeah, please do. And thank you again, Ric, for helping so many of our stackers get their financial planning in order over the years. You certainly helped a lot with mine. Just love your work.
Thank you, Joe. Feelings mutual. Thanks for having me again.